Hello, this is Eugene with Eugene Financial Management. I'm a portfolio manager for all active equity strategies we have at the firm, and I would like to update you on stock market today. Um, Please take a look at the disclaimers and disclosures. All right. So today we'll talk a little bit about the U.S. equities. I will update you on the size and style dynamics in the marketplace. We will take a look at yield curve. I will go over the our macro forecast for economic sectors we do in-house. Then we will take a look at micro factors, what has been working and what's not. And then we will dive into the actually the individual equity strategies. And I will update you on the changes we've made to our strategic all equity portfolio and strategic dividend equity portfolio. Judging by the numbers, the global economy is growing, and this quarter it's probably going to grow at least at 3%. We see very interesting dynamics in the marketplace. And I will talk more about the implications of top-line growers dominating the market in the United States. We still believe the environment remains supportive for U.S. equities in the long run, but we want to be selective going forward, and we still overemphasize the strong fundamentals and the fact that the market since the end of March preferred only one aspect, the top line growers, the companies which have grown sales in the last 4 quarters by big numbers dominated the marketplace. And markets didn't pay attention to valuations or profitability to some extent across the board. So the concentration was on sales growth, and the disparity between returns of those high flyers versus the market averages have reached pretty big numbers. Judging by history, we came across one study which showed that such a huge gap in performance has been achieved 8 times in the last 65 years. And we're experiencing the second largest diversion. And usually those instances are followed by a strong reversion and more fundamentally sound companies with regards to valuation, profitability, safety outperform high flyers over the next 12 months. So we'll see if history tells the truth, but 7 out of 8 instances, historically speaking, showed that dynamics going forward. Also, markets are reaching all-time highs, but at the same time, there's still this reservation about the potential trade disputes. And we saw how market reacted very positively to the accord reached between the United States and Mexico. And we believe should the disputes between U.S. and China have been resolved, the market would be even higher than what we see today. And probably the preference would be to a broader group of companies rather than just a small sliver of top-line growers. From our style cycles, again, as I've mentioned, we were in a very strong growth cycle. We saw at the beginning of the year a move towards neutrality. It kind of paused over the last few months because of the implications of the trade disputes. So at this point, the market prefers the what's perceived to be safer bets with regards to continuous growth. Um, but we truly believe that because of the empirical evidence of mean reversion after such a huge dominance of sales growers, we would rather be in a neutral regime for a potential mean reversion. With regards to size, obviously we're looking at a 3-year average dynamic here. So we find ourselves in a small cap regime when small caps outperform large caps, and usually those cycles are a bit longer than the style cycles. So we would assume that small caps could dominate large caps in the near future. Obviously, we hold our hand on the pulse, so to speak, of the U.S. economy, and by looking at the yield curve shape and the credit spread, we try to assess the possibility of fever, so to speak. So looking at the yield curve, it has been flattening. A lot of market participants voiced their concerns about that. But what we found out is that even with the flattening yield curve, if you look at it on a standalone basis, it does have some predictive power, but it's much more beneficial to look at yield curve in concert with other macro factors, and that's exactly what we do here at Signet. So we came across a recent study conducted by Federal Reserve where they showed that actually looking at the shorter-term yield spread, not the traditional 10-year to 2-year difference, but let's say 2-year to 1 year or 6 months to 8-quarter differential actually makes more sense because this signal captures the probability of upcoming recession a little more accurately, with much more accuracy, again, judging by history. So the red line here, the greenish brown line is the traditional yield curve, and the red one is a shorter spread, interest rate spread. So you can see that interest rate spread is a little more predictive with regards to upcoming recessions in the next 4 quarters. So at this juncture, we don't see that indicator diving in the negative territory, which would indicate a probable recession in the near future. So that's a promising sign for the near future for the U.S. economy. So as I mentioned, we do have a proprietary system, the model, which looks at a whole bunch of macro indicators, your traditional economic indicators like GDP growth, inflation, employment. We also add to that mix indicator from stock market and from bond market as well. And by running models, we try to predict the health and the performance, relative performance of broader economic sectors over the next 12 months. So what we see right now is a very interesting picture where we look favorably upon staples, healthcare, information technology, telecom, and utilities. We've upgraded consumer discretionary from negative to neutral, and we'll look at a whole bunch of sectors like energy, financial, industrials, materials, and real estate to be a little weaker over the next 12 months. And you can see that discretionary and IT got upgraded recently. And what's interesting about that move is that it was predicated on one economic indicator being revised. And this economic indicator is personal savings rate. and it was revised like twofold by the Bureau of Economic Analysis recently, and definitely that change impacted our forecast quite a bit. So we find ourselves in a very interesting barbell shape where we have some cyclical, like consumer discretionary and information technology. Those are cyclical sectors which do well during the expansion periods of the economy. And also we have a positive view on some defensive sectors like consumer staples, healthcare, and telecom and utilities. So we keep our discipline. We are looking for well-rounded companies. We still are biased towards growth at reasonable value. We think in the long run, the more all-encompassing framework of picking stocks should prevail versus concentrating on only one aspect in the short run. I talked about the personal savings rate revision, which makes us even more hopeful about the U.S. economy because since consumers stash away some of the cash and their savings are on the rise, it means that should the U.S. economy hit a soft patch, consumers would have some money to carry them through those rainy days and really sustain some level of consumption. And we see still U.S. economy as the leader of the world economy, and hence we would like to have companies in the portfolio with a healthy exposure to the U.S. market. So we talked about the macro view of the market. Let's kind of dive into the micro view and take a look at factors we use to select companies. We've got 3,500 stocks to work with in our universe, investable universe, and we analyze each stock through a prism of a multi-factor model. And this multi-factor model consists of the broader groups of factors. And those include, obviously, valuation, how cheap company is, profitability, yield, momentum, growth, and safety. And what this heat map shows, it demonstrates how well those subgroups work from month to month. And so what we do, we rank the stock of the whole universe of stocks based on each individual subgroup, and we take the average performance, the median performance of the first quintile, the first 20% of the best stocks in this category, and we measure that against the universe average. So when it's red and negative, it means that this subgroup doesn't really work or underperforms, right? And when it's green, it means that the subgroup factor actually does contribute to the positive return. So what's interesting about this heat map, if you look at 2017, we've got a whole bunch of factor groups which work, right? And overall, the all-encompassing score worked. And then coming into 2018 up to March, we had an iffy 50-50 type of situation. But after the trade war with China was kind of announced, the war hinted on in late March, we see that in April, May, June, July, and continuing in August, pretty much all the subgroups don't work. And what's funny about this, you would say, well, Eugene, if you talked about the growth companies and top sales growers dominating the market, how come the growth factor doesn't work? Well, you have to remember, we look at those groups of factors on a sector-by-sector base, and we take 20% of the best companies. So what has been dominating the market is a very small group of companies. And that's why when you look at on a broader scale, those factor groups don't really come across as working in the recent history. Again, this situation is usually very unsustainable, and we hope there's going to be a meaningful reversion going forward. So, not surprisingly, even with the good sector posturing, the fact that we actually overemphasize sectors which prevailed year to date. Within each sector, we didn't really have much success because of what I just showed you, the reversal and in the scoring system. So we had pretty much all these sectors underperforming year to date, and the only two contributors were real estate and utilities. Because of what I just talked about, we didn't feel like making too many changes to our portfolios because we believe there's going to be mean reversion and things will go back to more normal, and market paying attention to multiple fundamental factor groups. So with this in mind, we really made only one change in the portfolio. We sold Oracle, we trimmed Google just a little bit, and we bought a small position in Alibaba and B&G Foods. So in fact, we increased mid and small cap. We try to keep our neutral posture, but we still have a guard bias in our exposure. And we keep our overweight in technology, but it's just reduced a little bit. And we closed the gap in consumer staples because overall sector consumer staples came down in valuations quite a bit in the last few months. So this is the composition of our strategical equity portfolio, and you can see it's a very well diversified strategy with very healthy representation of information technology, healthcare, financials, and consumer discretionary. And from the size and style standpoint, this is our own classification, which is obviously dominated by GARPer, although you see large cap growth, but a lot of those growth companies are more of a growth at reasonable price companies. And to your right, this is actually the breakup by Morningstar classification, and you can see that blend, meaning growth at reasonable price, is very well represented in the portfolio. And we still have a very healthy medium and small cap presentation in the portfolio. With regards to changes in our strategic dividend equity portfolio, again, not too many changes. We maintain a large cap posture. We actually reduced some of the value exposure and added some of the growth exposure because we could find, mispriced stocks with good dividends and good growth prospects. We reduced financials by selling Apollo and Bank of Nova Scotia, and we increased a little bit consumer discretionary and IT with Carnival Cruise Lines and Intel. Again, strategic dividend equity portfolio is a very well diversified strategy with financials, information technology, healthcare, and consumer discretionary very well presented. But overall, we have very good representation across all the sectors as well. And from the size and style standpoint, judging by Morningstar classification, we are tilted towards value with pretty good GARP classification. And Obviously, this portfolio is a little more conservative, so we've got 70% in large cap, 23 in mid cap, and a good 5% in small cap. Thank you so much for sticking with us. And if you have any questions with regards to this presentation, do not hesitate to reach out, and I will be able to answer as many questions as possible. Have a good day.